Well, thank you, Marcus, very much, and to everyone for organizing the conference. We're honored to be a part of it, and today I'll be talking about research I'm doing with Alex Butler and James Weston from Rice University on racial discrimination in auto lending. I don't think it's difficult to motivate a study of discrimination in any setting. It's always important to root out discrimination, but there are a few things I'd like to say about the auto loan market. So first, it's the most widely used form of installment credit by US households with over 100 million borrowers, and it's incredibly important for lower and moderate income households. The market is also much less regulated and less transparent than other major consumer credit markets. So if you think about mortgage lending, these lenders report information on each application, the race and ethnicity of the borrower, and information on their decision through the HMDA Act. Right? Whereas in auto lending, there's no systematic reporting of either applications or loans to regulatory authorities. And this has generated concern among regulators. In particular, the CFPB issued a special bulletin in 2013 where they basically put auto lenders on notice that they were going to work to increase their anti-discrimination enforcement efforts. And they backed that up by finding Ally Financial, which was formerly General Motors Acceptance Corp., almost $100 million at the end of 2013 for charging minorities higher interest rates. And so despite some of the concerns here, we know alarmingly little about the existence or prevalence of discrimination in this market. And so what we do know really comes from a prior study by Charles Hurst and Stevens at AERP&P in 2008. And so they use information from the Survey of Consumer Finances, where they have 2,700 white borrowers and 320 black borrowers, and they can tell us that black borrowers are paying higher interest rates than whites, especially at the 75th percentile of the rate distribution, which is sort of the typical subprime borrower. It's about 1.34 percentage points. But this data set doesn't have information on credit scores, and they can only look at interest rates, not approval rates or default rates. So it's just very difficult to draw strong inferences about discrimination based on this data. And so why do we know so little? Well, that's straightforward, right? There are these big data limitations in this market. And so how do we get around this issue? Well, we're going to go and construct a novel data set that puts together credit bureau data with Home Mortgage Disclosure Act data. The credit bureau data is a 1% nationally representative panel. It has a rich set of financial variables. We can see borrowers' credit checks, which tell us when they're applying for a loan. We can see when they take out a new loan. We can see their credit scores, delinquencies, etc. So this has the information we'll need to study auto lending. But it doesn't have race or ethnicity. So that's where we go to the Home Mortgage Disclosure Act data, which covers 95% of all mortgages and has information on race, ethnicity, sex, and income. And these two databases are de-identified, right? But we found a way to link them because the characteristics of originated loans are reported in such granular detail that you can actually uniquely match the loans based on the characteristics. And so we're able to do this and match 69% of mortgages from the credit bureau data to their HMDA data observation. So the data set we're working with is still de-identified, but we have this panel data set of credit bureau information with race and ethnicity merged on for 79,000 homeowners from 2005 to 2017. And we need to take that data and go test for discrimination in auto lending. So here we want to be clear about what we're defining as discrimination. So we're striving to isolate discrimination that's rooted in biased preferences. So you can think of this as taste-based discrimination as described by Becker, or biased beliefs like stereotypes. Recent work by Bardolo et al. Really outlines this. And either of these human biases would lead lenders to forgo some profitable contracts with minorities. And the prediction that that's going to generate is that loans to marginal minority borrowers are going to be more profitable as lenders are setting this bar higher for how profitable a loan has to be to make it. And so we're going to work to distinguish this from omitted variable bias, which would occur if minority status is correlated with unobservable factors that lower creditworthiness. And we're going to work to distinguish it from statistical discrimination, which is when lenders seek to maximize their profits by using race as a proxy for information that is unobservable even to them. You can think of this as minorities using lenders using information about minorities on average as a stand-in for information about the individual. Right? And although we're going to try to make this distinction between the human biases we're talking about and statistical discrimination, for economic reasons, it's important to highlight that statistical discrimination itself is illegal in the United States. So how do we go about testing for discrimination? We follow 3 approaches. So approach 1 is to test whether minorities have lower credit approval rates. Second, we look at whether minorities pay higher interest rates. Right? And for both of these approaches, we might expect that omitted variable biases could work in favor of finding discrimination, and we also might be concerned about statistical discrimination. But we're going to use this third approach, which is to ask whether loans to marginal minority borrowers are more profitable. Right? And this test is by far the most stringent test for discrimination. And we're going to be looking at whether minorities are defaulting less as a sign that the loan is more profitable. And this is the outcome test described by Becker. And the reason that this is the most stringent test is because the omitted variable biases that we might be worried about in approach 1 or 2 should work against us here, right? They should result in minorities defaulting more than the model suggests, right? And instead, a finding of discrimination would be to show that minorities default less, right? So this is going to be our most convincing test. If you think about the lending discrimination literature, a lot of it is focused on mortgage lending. They've typically applied approach 1 and approach 2 and found evidence of discrimination. But then when you look at defaults, the evidence is much weaker or actually doesn't find discrimination. But we're going to be able to employ all 3 tests in our auto lending setting. What do we find? Well, we find strong evidence of discrimination. Minorities face a 1.5 percentage point reduction in their approval rates. That crowds out about 80,000 loans to minorities per year. They're paying interest rates that are 70 basis points higher than comparable white borrowers. What does that mean? Well, it means it's about $410 in present value at the time they took out the loan. And we're finding that minorities are defaulting less, controlling for borrower and loan characteristics. Again, suggesting that the loan to the marginal minority borrower is more profitable. The cross-sectional variation in these results strongly supports a discrimination story. So we're finding the results are larger in cases where loan officers have more discretion, in states where racial biases are more prevalent, and in areas where there's less competition among lenders. And then in the last part of the paper, we're going to get to look at, is there an opportunity for increased enforcement to root out some of this discrimination? We use this policy shock by the CFPB in 2013, where they increased their efforts, and we find that it was effective in reducing interest rate discrimination by nearly 60%. Unfortunately, this policy was largely halted in 2018, and so we'll get more data in the future to see whether discrimination has come back. But while in effect, this policy was incredibly effective. So our first main result. So here we're working with this data set that has basically all the credit shopping attempts of minorities and borrowers from 2005 to 2017. And our outcome variable is an indicator for whether a credit shopping attempt is successful. And we're going to control for factors like sex, age, income, credit score, a bunch of other financial ratios, as well as zip code characteristics and state and year fixed effects. And what we're finding in column 2 is that minorities have a 1.5 percentage point lower approval rate. And when we look at the difference between applicants who are Black versus Hispanic, we find a slightly larger effect for Black applicants, but that difference is statistically insignificant. And in columns 4 and 5, we see that the effect is larger in the subprime sample, again, where loan officers or dealership finance officers have more discretion. Now, we're going to look at this cross-sectional variation. So what we're doing here, we're plotting on the y-axis a state-level estimate of the reduction that minorities face in credit access in that state, the reduction in approval rates. And we're plotting that against, on the x-axis, our measure of racial animus, which is the Google search volume for racial slurs in that state, which has been vetted in a recent top econ paper. And so we're finding this strong correlation where minority borrowers in the states with the strongest biases are facing the largest reduction in credit approval. When we put this on a map, what does it tell us? Well, the areas that are shaded dark are where we find the strongest evidence of discrimination. So basically the Deep South, the Ohio River Valley, and parts of the Southwest. So next, we're going to formally test this cross-sectional variation. So here we are running that same test from the prior table, except we're interacting the minority indicator with the racial biases of the state and an indicator for low banking competition. And so what we're finding is that the discrimination minorities face is 3 times larger in the most racially biased states, that top tercile in terms of racial bias. The effect is also larger where there's less banking competition. That helps us distinguish between the taste-based costly discrimination versus statistical discrimination. So if what we were capturing is just statistical discrimination, you shouldn't see this relationship to banking competition because that type of discrimination is profitable and competition doesn't root it out. But instead here the evidence lines up with these human biases. And next we're able to conduct a falsification test where we take advantage of the breadth of the credit bureau data. So we're able to look at these same applicants who are applying for auto loans, and we're able to look at them in that same borrower year. And we're looking at their credit card applications. And importantly, the credit card lending process is basically completely automated at this point. And so what we find is that the same minority auto loan applicants, they do not face difficulty in obtaining credit card credit from credit card lenders, and the cross-sectional variation evaporates, right? So this strongly suggests that there is not some omitted variable about overall borrower creditworthiness that's driving our results. The results appear to be coming from the human component of the auto lending process. So next, we're going to shift from talking about credit approval rates to talking about interest rates on loans that are originated. And so here, what we're finding in column 2 is that minorities are, again, paying 70 basis points higher interest rates. What does that mean? Again, that's $400 in present value at the time of the loan. When we interact it with racial biases, it's 3 times larger in the most racially biased states. And again, this is soaking up. It's already controlling for all that information about borrowers' credit scores and incomes, etc. And we find some evidence that it's stronger in areas with less lending competition as well. And so now we're going to move to this most stringent test where we look at the default rates, right? And again, if omitted variable biases are driving any of our results, that should lead to higher default rates for minorities. Whereas here, a finding of discrimination would be lower default rates, right? And so when we look at it, we do find indeed lower default rates for minorities, and especially in the subprime sample. So the idea here is that if you're setting a higher bar for minorities to clear in order to get a loan, the marginal minority borrower is going to be more profitable or default less, right? And so when we're looking at the subprime sample, we're trying to zoom in as close as we can to that extensive margin of credit provision, because that's where we'll have the most ability to detect these differences in the marginal profitability. And that's where we're finding this strong negative effect, where we have lower default rates for minorities. And again, relative to evidence in other markets, this is really strong evidence of lending discrimination. We've thought carefully about other factors of loan profitability, such as prepayment risk, but that's actually higher for white borrowers. We also make even incredibly extreme assumptions about what the differences in recovery rates could be, and it just simply cannot plausibly explain any of our results. Even if you assume that you just could not recover collateral for minority borrowers, even that intentionally extreme assumption could not explain our results. And so now in the last part of the paper, we're able to look at the effects of the CFPB's policy. And real quick, there are basically 2 streams of auto lending. There's direct auto lending, which is you go to a bank and you ask them for a loan. And then there's indirect auto lending, which is you go to the dealership, they help you arrange financing with a third party. Something important to note here is that although you don't interact with that third party, the third party lender basically submits a minimum interest rate that they'd be willing to charge you to the dealership. And then a finance officer at the dealership has the discretion and the incentive to mark up that interest rate. And when they walk to you and say, well, here's the interest rate we can offer, it's that initial buy rate from the lending institution plus any markup that they've put on it. And so basically this aligns incentives so that dealership finance officers act a lot like a loan officer at a lender would. So there's discretion in both forms of lending. And the CFPB specifically said that they were going to increase their efforts at rooting out discrimination in indirect auto lending, in the non-bank lending. Again, this happened towards the end of 2013. And so what do we find? Well, a picture can pretty much tell these results for us. So here on the y-axis, we're looking at the additional interest, the additional APR that minorities pay. And again, this is conditional on controlling for their credit score, income, and all those other factors. And in the left plot, we're looking at areas of the country where non-bank lending or indirect lending is most prevalent. So this is where the CFPB's efforts were focused. And what we see is this large reduction in interest rate discrimination immediately from 2013 to 2014. Right? When we look in the parts of the sample in the right plot here, where there's less indirect lending, so again, less CFPB scrutiny here, we see less of a reduction in interest rates. We still do see some reduction though. And so putting this all together, we find that this policy initiative led to, when you combine the entire country, it led to a 60% reduction in additional APR paid by minorities, from 84 to 35 basis points. So it was incredibly effective. It had no effect on interest rates for approval rates for minorities. That's really important because it tells us that the additional interest that minorities were being charged before the enforcement efforts, right, was not necessary to make these loans viable because they kept making them afterwards, even at the lower interest rates for minorities. And so this is some of the first analysis of the CFPB's actions. Even they don't really have the market-wide data to test the effect of their actions. And it's really important because this CFPB oversight is controversial. So this enforcement effort ramped up in 2013. It lasted through 2017, and then it was actually effectively canceled in 2018. And so with that, I just want to say thank you very much. We really appreciate the opportunity to present our research.
So I'll just jump right in with a few questions. Thank you very much. And I'll share those questions. Okay, so really like this paper. This is a really creative use of data. And I think there is a real hole, just like Erik said, with respect to auto lending. So this is, I think, a real contribution. But I did have a couple of questions. So there seem to be, though, audit studies, a variety of audit studies that exist that are focused on auto lending. Could you tell us a bit about, say from the National Fair Housing Alliance, could you tell us a bit about how your results differ from theirs, since you were using administrative data and they were doing the audits?
Yeah, there's a great NFHA audit study in 2018, I believe it was. And so what they typically run paired audit studies. They send two people to the same dealership, one's white, one's black. They have the same financial characteristics, and they see how they're treated, right? And so typically in those studies, you see it at a small number of people. So they ran this with like 10 or 12 individuals and a small number of dealerships. And the concern there is that, well, maybe we're catching sort of a few bad apples in terms of the dealerships. And someone could argue, well, this borrower could have gone and found a different lender elsewhere who didn't discriminate. And so I think the need for the market-wide studies is to identify this market discrimination, to show that just better shopping efforts couldn't get you around these issues. And so I think that's our main contribution, as well as to we can do things like quantify the aggregate effect of the additional interest minorities are charged. So I said it was $410 per minority. When you quantify that, it's about $1.7 billion a year in additional interest that minorities are paying. So we can come up with these aggregate statistics as well about 80,000 loans a year that are crowded out by discrimination. And I think that's really useful.
Okay, thank you. Okay, so one criticism of the economics profession has been that we are really good at identifying racial disparities or racism, but we rarely have anything to say about it. So what should be done to address this disparity now, absent the reinstatement of the CFPB rule? So when I say now, I
Oh,
mean like
absolutely.
September 18th. Yeah,
You just
September
took away
18th.
my,
I,
my,
I know, I
my
know, I
answer.
know.
Um, well, so I think that that was one of the things that actually is a strength of our study is no, a lot of these studies on mortgage lending discrimination is that it's hard to identify a major effort. And here we did have a major effort by a
Mhm,
regulator, and we
mhm,
could really test for its effectiveness. And
mhm,
so I think that that is our first main answer is that those efforts should be brought back to their
mhm,
2016
mhm,
levels or increased,
mhm,
right? The second thing is I think based on some of our results on competition, anything that we can do to facilitate lending competition and make credit shopping easier so that borrowers,
mhm,
so just the general improvement in technology over time is probably helping with that. But
mhm.
anything that we can make credit shopping easier and make it more competitive would also help. But I do
So,
think there needs to
yeah,
be some systematic reporting of
mhm,
applications and loan decisions in order to. So the CFPB is in a really tough position where they are
mhm.
they're charged with trying to prevent discrimination in this market, but they can't see any of the applications or loan
Right,
decisions. So how
right.
do you do that, right? I mean, it's
Mhm,
incredibly difficult. They have to rely on complaints and things. Um,
mhm.
so I know some of this
Okay.
would be costly, but I think when we compare the magnitudes in the auto lending compared to mortgage lending, I think they're much larger in terms of discrimination in auto lending right now. And you can't
Mhm.
help but look to the fact of how differently regulated the markets are.
Right, right, right. Okay. So on the one hand, we have regulation. Is there enough innovation that is happening in the auto shopping market that would spill over into the auto loan shopping market that could mitigate these effects?
That's interesting. Um, I think any improvement in shopping for auto loans, whether that's directly or indirectly through shopping for cars, is going to potentially at least limit some discrimination, right? If you shop around really aggressively,
Mhm,
hopefully you can avoid some discrimination. But actually, we kind of thought about this and we were worried,
mhm.
well, in our sample, are the minorities shopping as intensely as the
Right,
white bars
right,
in our
right,
sample?
right.
And so we looked at the
Mhm,
people who failed to obtain credit, and we can
mhm,
see the number of credit inquiries we have. You can see how
mhm,
hard they shopped. And the
mhm,
denied minorities, the minorities who didn't get loans, were
mhm.
shopping as much or more than the
Right.
white borrowers who didn't get loans. So
Mhm, mhm,
that
mhm.
suggests that at least in the current environment, I'm not sure shopping can completely eliminate the problem.
Right, right. And it didn't completely eliminate the problem the last time I shopped for a car. That's another story. Anyway, uh, um, so I've been recently looking at the census household poll surveys and looking at how difficult it has been for households to meet various bills. So mortgages, I'm typically looking at rental assistance and housing payments, but I looked at overall expenses. So what I worry about is that given this lifting of the CFPB rule in 2018, we don't have the data that we would have otherwise. And plus, we're in this pandemic now, and this would happen with a lag, even with your great matching technique. So what I calculated was that 44% of Black households were having trouble. This is the latest one. So this this is the end of August, I believe, the household poll survey that was at the end of August. 44% of Black households were having trouble meeting their general expenses, Hispanic households 42%, and white households 25%. So what would you project is happening to Black auto loans? So how do auto loans compare to general expenses versus mortgage payments? I mean, this is, there's certainly not, mortgage payments or rental payments are typically, an order of magnitude larger or something like that. Certainly larger typically than auto loans. So what do we think is going on now with respect to auto loan payments?
Yeah, I think there are probably a couple directions that could take that, but to be concise, so I think one of the things you're asking about is kind of the pecking order in which people make their payments. Like, if I'm struggling financially,
Mhm,
what bills do I keep paying, right?
mhm,
And so the one thing about auto lending is that collateral repossession is much easier. So if you stop paying your auto loan, they can repossess your car pretty quickly.
Right.
If you stop paying your mortgage, it can take quite a while. So actually, I think there's some research showing that during the financial crisis, people kept making auto payments more than they kept making mortgage payments. And when they had to choose, it's like, well, I need my car to get to work. I can maybe work something out with my mortgage lender. I would expect, again, that's taking a crisis 10 years ago and bringing it to today, but I would expect some of that to still be going on.
Okay. Okay.
Is there another direction?
Well, yeah, there's another direction, but you know what? I'll not take up more time that I have. I want to get to the questions in the chat. Let's see. So I'm going to stop sharing, and or in the Q&A section. So one question from Anand Goel is, does profitability analysis control for systemic risk factors that may impact minorities differentially?
Yes, so there we are. We're controlling for things like credit score and income, and if there were factors that were making minorities less creditworthy, we'd expect them to default more, and that's where we can pretty directly test that, and we're not finding it there. Another thing which I didn't mention in the presentation today is that although the interest rates for minorities are much higher in the most racially biased areas, when we just go look at the default rates, and here we're not going to control for interest rates, but just look at the default rates, we see a mismatch, and we don't see that they're defaulting more in the most racially biased areas. So they're being charged more, but not defaulting more. And so that's also some evidence on that front.
And in the National Housing Alliance study, they used more creditworthy minority borrowers and less creditworthy white borrowers, and the white borrowers were still quite successful.
They were sort of offered
they're more successful, right?
Options, lower rates. So there's that anecdotal evidence, which is really strong, and then we take this to the full market.
So Elizabeth Sturbins says, I'm a licensed marriage and family therapist and work with clients as they are navigating their issues and have a specialty with financial therapy. With the results of these studies clearly showing systemic racism and discriminatory policies, what types of options would you suggest for these clients who are navigating these problems? So this is for clients. You and I were talking about markets.
Question, yeah.
So she's talking about clients specifically.
So I think something that is probably understudied is the path dependency in all of this, in the sense that facing discrimination in maybe a credit card, or so maybe a mortgage, or sorry, an auto loan, what sort of long-term effects does that have on borrowers? Does it make them then in the future less likely to get other types of credit? So I do think there's this, or less likely to get that job that they needed their car to get to. So there's this idea that little bits of discrimination continuously compound, right? And that speaks to something that I think needs to be studied more in economics, but then it also creates a lot of the issues that I imagine that you're dealing with your clients. I'm not going to step too far outside of my expertise and tell you how best to advise them, but I can just say what they're facing is real, right? The discrimination that they're facing is real, and I think our paper shows that. In terms of dealing with it, credit shopping is a tool. It takes effort, though, right? This is all of these. The discrimination is putting a burden on the people who are suffering it clearly, right? And so that's where I think you're probably doing great work, and I wish I had even more to say. Yeah.
So another question that has come up is you seem to define the marginal minority borrower as just a subprime minority borrower. Are there more refined ways to select the marginal minority borrower?
We would love to hear ideas. I think in our current setting, that's probably the best that we can do. But we've been thinking about trying to hone in on that margin even more. But I think a lot of prior research has shown and argued that to the extent that you can't identified the literal marginal borrower, pooling them with the average borrower works against you finding discrimination. It weakens the test a little bit. And that's certainly been argued extensively on the mortgage lending side of things. So I think our ability to, as we subsample and get closer to the margin, the result gets stronger. So the result is we're finding it where it makes the most sense to find it if it's driven by discrimination. And our inability to perfectly hit the margin probably works against us. So I think we're making our best efforts, and but if we have suggestions, we're definitely open to it.
I think this may be our last question. I'll do a time check as soon as I articulate it. Does the effect depend on competition between auto dealers? For example, does dealership concentration matter?
So we would love to test that, right? And we think the results would probably get stronger if we had a really good measure of kind of the combination of dealership and whether you're in an area where there's a lot of dealership financing. Getting a huge database of auto lender dealerships is something we haven't embarked on yet, but that would be an interesting sort of addition to a paper, or maybe even an offshoot into a second paper that really focused on the indirect lending side of things. Right now, we're trying to focus on market discrimination overall because borrowers could substitute between indirect lending versus direct. So we're analyzing the whole market, but I think there's another paper to be written on specifically indirect lending.
Okay, so Erik, thank you. Well, I think we've exhausted the questions that have come in. So Marcus, what would you like to do? I can ask him questions for days.
Well, there are some in the chat box. So there were some came in Q&A and some in the chat.
Ah, okay, my bad. Oh yeah, okay. Let's do one more question then.
Let's spend another 2-3 minutes and then.
Okay. Just didn't want to get us behind. Okay, so there's another geographical concentration question. Given that you have the mortgage data and the auto loan data, do you find similarities, differences across these two markets on a regional basis? I find the comparison with credit card lending most interesting since it stresses the human component.
Yeah, that was our motivation for the credit card lending test as well. Trying to work with people with similar hard data and similar algorithms, but taking out that human component. In terms of mortgage lending, we haven't done, maybe there's another paper to be written there to look at the interaction of discrimination between those two markets. There is a wealth of great research being done on mortgage lending discrimination. Adair Morse has a really nice paper right now about discrimination in that market. I think we wanted to do one really clear thing in this paper, which was focused on the auto lending side. But maybe there's some tests, either a new paper or a robustness test that we could compare it to the mortgage market.
So this is a really quick question, if Marcus will allow us to go ahead and ask it. And this is bringing us up to date. Again, have the premium returned post-repeal? Have you all looked at the data since? We
would love to.
Yeah.
So our data is coming in with a little bit of a lag, I would say.
That's what I thought.
Yes, if we're still working on this paper 2 years from now or a new sort of offshoot of it, I think we would do that, absolutely.
Okay, well, thank you, Erik, and thank you, Marcus, for the opportunity to discuss this great paper.